Well, good morning and good afternoon to all of you, and thank you for joining us for this UNFIF virtual roundtable on governing artificial intelligence in finance, which forms part of a series of ours which looks at longer-term trends and issues in financial markets. My name is Adam Cotter, and I head up the Asia office of UNFIF here in Singapore. Now, to manage and have the best flow of the conversation for the session, we're going to start with a 15 to 20-minute presentation from the Banque de France's Supervisory Authority, followed by a 20-minute moderated panel discussion. We will then use the remaining 30 minutes or so for a Q&A with our attendees. This is also a good time to remind you all that this will be an on-the-record conversation, and you can also subscribe to receive our updates by going to onfif.org/subscribe. So we're very pleased to have a great lineup of speakers with us today. Given time is short, please excuse me as I'll spare lengthy introductions, but today we have joining us Olivier Flich, who's Director of the FinTech and Innovation Department at the Banque de France's Supervisory Authority. We have David Hardoon, Senior Advisor for Data and Artificial Intelligence, Union Bank Philippines, who's still joining us from Singapore, but waiting to move to Manila, and Yair Zik, who's the Assistant Professor at the University of Massachusetts in Amherst, who's also joining us from Singapore and awaiting a move to the US later in the year. Now, we're here today to discuss the principles for sound development of artificial intelligence governance and the development of it more broadly in the financial sector. And I would like to start off the session by handing over to Olivier from the Banque de France for his presentation, and then perhaps later we can also dig down into some of the future economic, geopolitical and technological developments that may influence governance of AI in finance in the coming months and years. So Olivier, please, if you'd like to start.
So I would like, yes, to introduce shortly the work we've been doing here at the ACPR since 2018, and which has resulted in a report published in June this year. Maybe the slide, the next slide 2, shows in a timeline, shows a summary of our work. We started in March 2018 by a survey on digitalization in the financial sectors, and we discovered that half of the R&D projects in the sector actually included artificial intelligence. So we thought it was time for us to look into this, so as to understand what were the concrete use cases of the market, the opportunities and risk, and also, and above all for us, the supervisory challenges. So we set up a task force with the market participants and other authorities in France to make this study. It lasted during the year 2018. And we published the first consultation paper, first discussion paper in December 2018. I will not, of course, elaborate on this paper, which is now quite old, but I would like maybe to mention that we sketched there a number of challenges and supervisory challenges for the market, which are, in my opinion, still valid. And of course, we did not explore all the routes that we discovered or we sketched in this paper. The next step for us was, after the consultation in March 2019, to move on to a more hands-on approach. One of the findings we made in the first report was that in the current situation, the challenges, especially the explainability challenges, the auditability challenges we have to face as supervisors, depends very much on the use case. So that's why we set up what we called workshops, where we decided to study concrete use cases with voluntary actors, be it banks, insurance companies, or consultancy companies. And the second thing we really wanted to do was to have mixed teams to study these use cases. We didn't want data scientists to speak with data scientists and leave the compliance or supervision experts alone. And we didn't want to have just an abstract discussion between compliance and supervision experts. So we wanted really to mix the teams so that data scientists are, I would say, obliged to explain how the algorithm works, I would say, to supervision experts and to compliance officers, and to have the reaction of these compliance officers from the banks and supervision experts from our authority to what data scientists could say. So to start this dialogue that I'm persuaded will have to take place in the next years. As for the question we wanted to study, they were quite simple. It's of course explainability. A supervisor, when a supervisor supervises, he likes to have explanation. So the first question for a supervisor is explainability, auditability, of course, and also the more general question of governance. Maybe in the next slide, I will explain what the summary, what we did after this series of workshops. Yes, so the next slides about the discussion paper. Yeah, thank you. So the discussion paper we published in June had three objectives. The first one was to provide feedback on these three series of workshops. So briefly, because I didn't mention that, the three series of workshops had three different themes, which are, I would say, important supervisory themes for the French Supervisory Authority, because it corresponds to its missions. So the first one was about anti-money laundering. Can AI improve the processes, the current processes? The second one was about risk models, of course, especially banking models, but also insurance models. And the third one, because we've got a mission on customer protection, was about customer relationship. And this one is particularly important in terms of explainability, because it introduced a new, I would say, another dimension of explainability, which is explainability to customers. So that's are the three themes of workshops. The objective was then to provide feedback on the three series of workshop. Also to try to make the link between technical principles, so AI technical principles, and, which is very important for us, sectoral regulation and supervision. So to identify whether there were gaps in the regulation, but the first step is first to try to adapt all sectoral regulation principles, which I think can be valid on a general level, to what we can see in the development of AI. So that's why, if you look at the report, we have introduced boxes where we try to state a number of principles for some development of AI. And the third objective, and not the least, is of course to open a consultation, because we are learning, of course, with these workshops. We are on the learning curve, and we are absolutely conscious that we can't at this stage have a firm and definitive view on everything. So we really want to have the feedback of stakeholders, that is to say, of course, the industry, but also the academics, This is very important for us because we really want to have a sound foundation of what we do, and other authorities or supervisory authorities. So that's why we opened this consultation until beginning September. If I still have the time, maybe I will give you a very quick overview of the contents of the report with the next slide. So the report addresses different questions. The first one is about the design and development of algorithm. So I would say yes, that's it. That's the right slide. So we have a part which is more technical, I would say, where we try to to identify, based on the discussion we had with the industry and with the use case, we tried to identify the 4 key principles for a sound design and development of machine learning algorithm. There is no surprise in it. It starts with appropriate data management, which is, I would say, the classical starting point of every development of machine learning algorithm. But nonetheless very, very important, especially if you want to get rid of a certain number of biases. Then we have a part on performance and stability. And above all, we try to introduce the notion of explainability, which is quite important for us, and I will elaborate on this. The question, I think the message here that we would like to test in the consultation paper is that we've got the impression that you can't achieve perfection on the 4 criteria, and probably you have to find the right balance between these principles, and that this balance depends on the use case. We elaborate this in the report, and especially in the annexes of the report, where we try to show concretely how you have to sometimes have a trade-off between performance and explainability, for example, or things like that. We also touch upon the question of the cycle, the life, I would say, the life cycle of the machine learning algorithm, which I try to summarize on the right of the slide. Just to explain that for a lot of processes in the financial sector, we supervisory authority see the processes as a continuous process of validation, which is particularly important in the case of machine learning because of the risk of deviation, I would say, or the risk that of evolution of the machine learning algorithm in the time. The second part of the report is about governance and control of algorithm. There I would say there is the link we try to make between the technical principles I've mentioned and the, I would say, more classical supervisory principles that we are used to supervise in our day-to-day missions. And there, the key issues there are the one I tried to summarize in the slide. The first and probably more specific one for machine learning is the question of integration into business processes. We had a number of discussions, and this is reflected in the annexes of the report, of how in the different use cases we studied, how the banks and insurance companies integrate their machine learning algorithm into the process. And this is very important for different reasons. The first one is the human algorithm interaction, because very often the algorithm is used by an employee. So the question is, does the employee has to understand what the algorithm, why the algorithm gives a recommendation or a result? Does he have to understand it or not? That's an open question, and it depends. The answer depends on the use case, and also how you integrate the algorithm into the processes, so to be able to monitor properly the algorithm. We have seen cases where, for example, the company had thought of a double process. I would say the main process given to the algorithm, but also a sort of parallel process still maintained and performed by humans, to be sure that they have still data and they have still results to train the algorithm. So that's just an example, but that shows that the integration into the business process has to be thought first for the process itself, but also for the monitoring of the algorithm too. The second point is, I would say, more classical. It's security and outsourcing. It's not because it's classical that it's not important, I would say. I would say that it's probably one of the major challenge in the future for many firms, especially outsourcing, because if you outsource, there is the question of mastering enough, understanding enough of the algorithm to be sure you keep the control. We also touch upon initial and continuous validation process, which are, I would say, a transposition of or set of rules or set of usual rules to machine learning. And the last point, which is of course very important for us, and I would say an additional word later, it's about audits. That's, I would say, basically the contents of the report. I would now just like to have two focuses in the two next slides before concluding. The first one is about explainability, which is summarized in the next slide. Yeah. So we had a number of discussion on explainability in academic seminars and also in the workshops. And what we thought would be useful for the market is try to show that actually there are different levels of explainability and also different understanding of explainability. So we chose to distinguish 4 different levels. I would say the first 2 levels, which are more a question of interpretation, and the last 2 are more in the field of explanation. I'll try to explain this. I would say the first level of explainability is just to see what the algorithm does. It's just a pure observation of what it does. He does this, he gives this response, and we can see the response, and I would say this is self-explanatory. There is no need of explaining more than what we can observe. This is, of course, a very, very low level of explainability, but this is a level that we can also see in our day-to-day life when we use our smartphone as when we try to look at the photographs, and that the algorithm just try to push or to analyze our photos, and we can see the results, and we don't need additional explanation. The second level of explanation is try to justify the decision of the algorithm. There, the exercise is slightly more difficult. Is not just observe the result of the algorithm, but give a reason for the decision. And I would say that we could say that is a low level of explainability, but probably that's the more difficult one, because it has also to be right. So you have to choose the right reason, the right cause for the decision, and so that sometimes it's not so obvious to have this second level of justification. I would say typically the second level of justification, of explanation, will be used to explain a decision to a client, to a customer. He's not a specialist of algorithm, so you will not, and there would be no sense in giving him a statistical explanation, but he needs, and sometimes he has the right and the right in the regulation to receive appropriate explanation. And this appropriate explanation is probably this level 2 of justification. Then you have the two more elaborated level of explanation, which are approximation and replication. There we are more in the field of data science, or yes, of data science, with two different levels of explanation. The first one is to have an approximation of the algorithm. We don't know exactly how it works, how the algorithm works, but we can develop methods for approximating the behavior of the algorithm. There are a number of explanatory methods currently developed in the industry or in the academic fields, which are trying to provide approximation of algorithm. So that's probably a level which will be very used by a supervisor in the future. The last one, the last level that we have called replication, but maybe it's not exactly the right word, but it tries to show that there is another level where you can explain the algorithm because you are nearly able to reconstruct it, or to prove step by step that what it does is correct and that you can explain it. We are aware that this level is not achievable in every case and in every type of algorithm, but when it's the case, of course, it's the perfect situation for a supervisory authority. So sorry for having spent a bit of time on this, but I think that was an important thing that we try to explain in the report. And the key message here is that probably in the future, companies will have to choose the right, and before, of course, developing the algorithm, they will have to choose the right levels of explanation, depending on the person for whom the explanation is intended, and of course, depending on the risk associated with the process or the regulatory constraints. So, and of course, he will have to choose this level of explanation. Sometimes he will have to have different level of explanation for the same algorithm. So we'll have, of course, to develop the most advanced level, and then to adapt it to the, I would say, the lower level of explanation. I think time is flying, but I tried just to summarize the next two slides. The next slide is about the challenge that we are facing, we supervisory authority are facing in the near future. It's about audits. How are we going to audit algorithm when, of course, they are in important and key processes for us? And what kind of tools do we have to develop for doing this? The tools we have listed are, I would say, corresponding to what I've said about explainability. That is, we can develop a number of analytical evaluation tools, which is we look at the code and we try to understand it. So I would say with the aim of having the maximum level of explainability. And we also have other empirical evaluation tools to develop. The first ones are the explanatory methods of the level 3 I've mentioned. but also we can imagine other ways of testing the behavior of the algorithm, because at the end of the day, a supervisor wants to get comfort with the algorithm and the process. So two other avenues, I would say, we have opened in the paper is about benchmark data sets and challenger models. We are very conscious that we have a lot of technical work to do for first exploring this and then maybe having this in our toolbox. But I think it's worth trying to explore with the market these two routes. And of course, for this, we have a challenge, which is probably shared with the market, but it's really an important challenge for the supervisor, is training people and also hiring talents for doing this, because we need additional expertise in supervisory authorities to have these new tools in our toolbox. I think I've now finished with my presentation. Maybe the next slide shows the next steps for us, which are the consultation, which is open until September the 4th. So we will get the feedback, and then we will be able to define the next steps very precisely. But what I would say what we expect is that what we would like is to make progress on audit methods and supervisory toolbox. We will have also to have a look at what kind of best practice we want to promote, and also whether Europe is going to design a regulatory framework. If it's the case, I think we will be happy to contribute to this with what we've learned in our workshops. And of course, we have listed a number of technical issues, and we will choose them after the consultation periods, which are, there is no surprise in it, but explainability. We probably have, again, further work to do on this. Biases, that I've not mentioned a lot, because biases is a question which is more general than only financial sector, and security. So that's, I would say, a very rich roadmap for us, and I'm very happy to share this with you and to participate today in this panel to discuss all this and probably much more with other colleagues. Thank you very much.
Many thanks, Olivier, for that. And I know certainly in this part of the world, and as you mentioned, you're seeing it as well, we're certainly seeing a hiring spree of central banks for people with the relevant skills to understand these new areas, which needs to be regulated. Of course, we have two data scientists with us as panel speakers today, so I'm sure we can also develop some of those points you made about algorithms as well. I just want to start with a bit of a broader question, Olivier, for you. We are also getting questions from our attendees. I'll certainly invite you to keep on sending these in. I may call upon you to read them out yourselves, but if you're having audio issues, of course, I can read those out for you. But I just want to ask you, Olivier, there's certainly a lot of hype around AI, and there's certainly a lot of exciting innovation occurring as efficiency measures are, of course, putting pressure and making it even more critical on the bank's bottom lines. But from a regulator's point of view, do you see AI being more of a risk for financial institutions and the financial markets, or more of an opportunity?
Yeah, that's a good question, but a very vast question, I would say. Is it a risk or an opportunity for the financial sector? I would say it's I would say the first one is, yes, it's an opportunity. It's an opportunity. We see this when we look at all the projects we see in the financial sector in France. There are many use cases currently explored by banks and insurance. This is, of course, about marketing. This is, of course, about selling products, but also the back office projects about, I would say, claims management in insurance, risk monitoring, fraud prevention, which is a field where AI is making progress, compliance, and also anti-money laundering. So there are many aspects where AI is an opportunity. I would say the first gains banks and insurance can have is try to develop AI when they have I would say industrialized process with with low value added in the human intervention, and where they can develop algorithms which are able to be specific enough to give a proper answer, and which have the power to do this on a large scale. So that's the first thing. The second, of course, are the risks. I would say there are three risks for the financial sector. The first one is, of course, well known by a supervisor. It's the question of the complexity and the difficulty also to implement AI in the current process of the banks and insurance. They've got many legacy systems, and I would say legacy methods. So they will have to change. There is a sort of cultural shift to be able to use and implement AI. They will have to invent the governance around this, and there may be also a risk of security if they outsource even more the AI part of that process. That's the first family of risk. The second family of risk is I would say, is to be late in adopting AI, and to let the fields open to other competitors. And that's a more long-term risk, I think. It's not a risk that we have, I would say, especially studied at this time, but we mentioned it in our report in 2018, is the risk that there is a sort of change in the ecosystem with some fintech, some specialized fintech maybe emerging, but also large big tech companies taking the advantage of their technological advance to reorganize the market and so change the relationship between the actors in the financial sector. That's not a prudential risk. It's not a risk that we supervise. I would say that we supervise directly, but I think we should keep this in mind, because of course, if the ecosystem have this type of evolutions, we supervisors will have to adapt also our supervision, because we will have other companies, entities to supervise that we are not used to supervise today.
Thank you, Olivier. And David, I'd like to bring you in here. You are a former central banker and now in the private sector. I want to get your views on what are the fundamental changes you think AI is going to bring to how the financial industry serves the economy. Feel free also to respond to Olivier's presentation.
Yeah, no, well, first of all, thank you very much for having me. I want to also kind of split, because AI is, as we all know, has been a term that's been highly abused in markets. So kind of also split it into two dimensions of digitalization and AI, because And interestingly, the situation we're in right now, being COVID, is an avid use case of justification as to the necessity of digitalization. So this is really about the ability of engaging digitally, collecting information. I mean, think about it, an avid justification to no need to signature anymore and the means of authenticate individual. Now, that now creates a phenomenal opportunity for AI, because ultimately you need to have the data in order to create these underlying services, these engagements, understanding behavior of consumers, and also using AI in terms of risk opportunities. For example, in cyber AML, those were mentioned earlier. So the amount of opportunities are truly limited by one's imagination. And having been in a regulatory environment and working with regulated environments, I want to also break this myth of, oh, the legacy systems, it's very difficult. It is difficult, but it can be done. In fact, the biggest obstacle of doing data and doing AI is mindset. And again, proof's in the pudding. We collectively locked down our economies, which meant overnight a person couldn't physically go to a bank to hand over their authorization form, sign something, do a transfer. And well, obviously it wasn't overnight. It took a bit of blood, sweat, and a bit more blood, and then a bit more tears. Suddenly, these behemoth digitalization and data solution started coming out of the woodworks. So that is proof in the pudding. It can be done. It is just painful, but it's a matter of having to do it. So that's number one. So the amount of opportunities are phenomenal. And of course, you can go to the whole dimension of financial inclusion, but ultimately it's even in providing the services and providing the ability and due diligence that one has to take place. But I want to also caveat that, because obviously it introduces new risks. And one of the things that worries me with, especially now that it's being done in a bit of a forced mechanism, is that it's not done in a patchwork perspective. Data science and AI does introduce new risks. Introduces new risks in terms of, for example, imagine algorithmic convergence. Once upon a time, you had to have a bunch of quants which were pretty much locked in a hidden room, running this stuff because it's proprietary IP. Now, every person can just run a cloud instance, use the libraries, and the algorithms are, again, the very families, roughly the same thing. The type of data we're looking at are roughly the same. The objective that we're trying to resolve, especially if it's on the money market side, are roughly the same. So there is a potentiality of risk from a prudential point of view of algorithmic convergence. So these are things that we need to start thinking of. And I just want to also just, because I took some notes down to respond on the presentation, excellent presentation, is we also need to, I'm trying to kind of retake it with stride, but we need to take a step back and really contextualize. I know there's a massive necessity, for example, explainability, and I'm the first one who would equally argue for the necessity of it. But we need to remember that this is I call it the onion, and the reason I call it the onion is because there's multiple layers and you cry with each one you peel off. Just as you need to know who you're explaining to, we need to also understand, what are we explaining? Why are we explaining it? And we need to equally avoid the risk of suddenly explaining things to anyone and everyone just for the sake of explaining it, because that doesn't solve or address risk. So there's a true necessity of breaking this down and saying, what is it that is truly important in an underlying process that it needs to be explained to address A, B, C, and D? And then what you find, and actually I really like the four-pillared framework, you'll start realizing that suddenly you don't actually need to know the mathematical execution of an algorithm, because it is the operationalization of it that bears the risk, not the math. Or in other situations, I don't know, it may be the underlying math. But it's really, really important, because the flexibility and the possibilities of using data and AI is just so broad. I mean, I half joke that being a so-called data scientist, I'm on a boat. Actually, I'm even on a boat. I can sail. And literally on the ocean, and saying, well, look, I can take you anywhere, in any direction, whether you want me to go through a nuclear-powered submarine, a sailboat, a dinghy, fly over it, but you need to tell me what is it that you want, in which direction, and kind of roughly where I'm going, and I'll get you there effectively. So there's a lot of these underlying considerations that have to be brought together in order to make sure that that innovation is occurring and it's done in a safe and resilient manner, whether it is newly introduced risks or impacting existing policies and regulations because of that shift that's occurring. For example, just very briefly, robo-advisor. Maybe the exact same thing, but you're now offering a, let's say, a very small investment product of, let's say we're talking about in the tens or even hundreds, so very, very small. But theoretically, you're offering it to an infinite number of people because it's a machine. Previously, you were thinking about systemically important banks, for example, because of the size, the scale, the way they operate. Now you can, again, in theory, have a startup which is running a digital bank, which can offer that deposit to a theoretically infinite number of people. Now, is that now digitally, systemically important? I mean, it kind of requires this necessity of taking a step back and saying, what is that impact effectively?
Great, thank you. Something about, I suppose, COVID, you mentioned briefly. Do you think then the increased social tensions post-COVID and this impact on AI could be a source of further risk in the financial system, where there's a situation where the sort of the have-nots could be missing out on some of the economic upsides of this adoption, and both digitalization and AI as you separate them?
No, absolutely, absolutely. And by the way, you actually just brought up another very important point, and I want to say, by the way, I'm as you can tell, I'm an absolute advocate of doing data and using AI. I mean, I won't be doing what I'm doing otherwise. But interestingly, again, COVID is another example of actually realizing how AI works. Because AI, at the end of the day, it's about finding patterns. It's about finding similarities or the differences within it. Now, if you would have built an algorithm and now COVID has happened, the whole mechanism of how we spend has changed. That algorithm is not going to work. If it was an algorithm, AI still, that was based on the construct of finding irregularities, it's going to work perfectly well. So that's just another thing that we need to have in the back of the mind. But to answer your question, absolutely. If you think about it, one of the concerns about, and again, it's a combination of digitalization and AI, is that we need to also be cognizant that while on the premise of inclusion, we don't result in exclusion because of that narrowness of identifying certain segments of behavior. Equally on digitalization, whereby only those who can have the access to are getting those services. And just to give you a little short spiel, in Union Bank, we've actually had this concept called Bank on Wheels. And it's effectively all you can imagine, the ATMs, all the digital services, and it's physically taking it to the people who may not have the mobile phones or the laptops to go online, by bringing the digitalness, that's not really a word, but I'll just make it up now, digitalness to them effectively. So it's something that we need to really think of as we're kind of pushing everyone forwards, that no one is left behind.
Thank you, David. I think we'll allow you that made-up word in this topic. So yeah, you've been very patient, and sorry we haven't brought you in earlier into the conversation, but it's good to get a sort of academic perspective.
Adam, you're being a bit cut off here. Can you repeat?
Really about your thoughts on how regulators should ensure fairness. Yeah, can everybody hear me?
No, Adam, you got cut off for the last 30 seconds or so. I'm so sorry.
Okay, but you can hear me again now. Okay.
Now I can hear.
We were lagging before.
Sorry about that, everyone. So yeah, I was just saying, sorry for being very patient, but it'd be good to get an academic perspective on how you think regulators should ensure fairness and privacy in financial markets as well. Do you think that current financial regulations are quite adequate enough for this?
Okay, so I can speak to the first part of the question. For the second part of it, do existing regulations ensure it enough? I'm not an expert on AI and the law. I can tell you a little bit about what I hear from other people who are experts on AI and the law. So in terms of what you can do to ensure privacy and fairness, so there are a lot of solutions out there, right? So my field of expertise is fairness, game theory, and now getting a little bit more into privacy, explainability, explainability. And there are solutions. There are technical solutions that you can implement in your bank, your financial institution. And much like David said, though, this needs to be a bit of a thought out process, right? You need to first of all think, what is it that you want to ensure and what matters to you? Because, for example, there is a lot of talk, I mean, in the EU about the right for explanation, and this was like a very significant part of the first talk. And one of the things that we are now coming to realize is that by explaining data systems, if you're doing it in certain ways, you can actually leak information, right? So let's say that now you denied me a loan, or you said that I engaged in some fraudulent behavior, like an algorithm decided it, and then you say, and then I ask you, well, can you explain the decision to me? So if I am an adversary, if I'm like a bad person, and I get a bunch of these explanations, I could get information enough to understand, for example, how the bank operates, like how the bank makes decisions, like basically uncovering the underlying data model that you use. Or I can use it to understand what data is the model training on, right? So I can uncover people's personal information just from observing enough explanations. So and this is especially true if people are not careful, because now what is happening is that a lot of companies are offering these fairness suites and the explainability suites. So Microsoft has one, Google has one, IBM 360. There's a lot of them coming out. And one of my concerns about all of that stuff is that people are hearing, okay, yeah, we need to make sure that AI is fair, we need to make sure AI is private and all that, and they're just going to pick up kind of off-the-shelf solutions and implement them, and not kind of fully understand what they mean and where they apply and what they're needed for. And sometimes the truth is that you have a trade-off. You cannot explain everything without compromising on privacy, and you cannot have privacy without compromising on some idea of fairness. So basically offering, for example, worse outcomes or worse explanations to certain protected minorities. So it's a complicated landscape, and you need to be a bit careful when navigating it. I will say a word, though, about the legal part of it. This is all from what my understanding is. I'm not a lawyer, so again. So right now there is, and this was also something that I picked up on in the first talk by Olivier, which was interesting. He said something like that: we need to make sure that the algorithms are not misleading people. And the argument that I heard from one legal scholar is that algorithms are tools, right? And attributing them any kind of agency in the sense of trying to assign to them any accountability is really problematic from a legal perspective. So we need to make sure that when we talk about explaining decisions from a legal perspective, we need to make sure that at the end of it, we assign responsibility to a human. We cannot, that human can be a lot of people. It could be whoever it is that's collecting the data. It could be the bank. It can be the company that helped design the algorithm, whatever it is. But assigning responsibility to the algorithm is a very dangerous precedent, let's say. So we need to be aware of that as well. So I hope I answered the question.
Yes, thank you. Yeah, it's comforting to hear you.
Adam, I just want to jump in.
The end of the humans. Sorry, David?
Oh, sorry. I just want to jump in on Adam's point. Yair's point, and say absolutely, irrefutably, and vehemently, one should never assign accountability to an algorithm. I mean, I'm trying to say it as PC as possible, but that's borderline stupidity, effectively. And because in the end of the day, like, I give you a very simple example. Now, let's say, unfortunately, Singapore doesn't have Teslas, but let's say I buy Tesla. I, honest to God, have no idea how it works. I understand the concept behind it. It takes electricity, converts it, and gets me from point A to point B. But when something breaks, there is a chain of command. Ultimately, there is someone that understands the process or a part of that process that is able to identify, even if it's a mechanical fault that one could never have predicted in the first place. But you never go like, oh, it's the machine. Yeah, nothing you can do about it. Just chuck it away. That will be a very, very disastrous point in time.
And I would just like to add to that is that some data companies take that line, right? So when you tell them stuff like, oh, well, your algorithm is behaving in a bad way, I don't know, like it provably discriminates against a certain ethnic minority or gender minority or whatever it is, then their answer could be very laconic. It can be basically, well, the algorithm trains on data, we don't really have control over it, and that's the way it was, and we'll try to correct it, right? So it's kind of like very passive approach, and it's kind of like so this is something that Professor Toby Walsh said, so not my words, but he said something like, with the current philosophy from a lot of data companies is, with great power comes no responsibility, and that is kind of a pretty alarming take. And I do hope that banking and financial institutions do not follow that line.
I want to answer one of the questions that popped up, which nicely ties to something I wanted to mention as well, is we need to be very specific when we look at an AI process. And we need to realize that it's in fact 4 things happening. And a lot of times we combine it to a single algorithm. The first one is you have data. Now, again, whether it is biased data because of collection mechanism, due to human maliciousness, due to whatever that may be, you have data. And there's a whole discipline, and there's a reason why that discipline place of data governance is extremely important. Then you have model development. Now, model development has its own governance and own best practices that are associated with it. That is different from data governance and data quality. Then you have model operationalization and model execution. It is critical these 2 things are separated. Why? Is you can have a absolutely racist model, but then when operationalizing, you have the mechanism to going, oh, hold on a second, no, I'm not going to execute that. That just doesn't apply. Because equally, if you look at a human processing, when we make a decision, we're actually making 2 decisions. We make the decision and then we filter it based on the acceptedness of my surroundings and my society. An algorithm can't do that. So we need to think, and then obviously the 4th portion is that the impact it may result. Because remember, unlike a, I guess, more legacy traditional rule-based approach, now we're very much designing closed loop algorithms, that are resulting in change and are learning back from that underlying behavior. So it could be the case of when you built it, it passed all the tests, but once executing, it resulted in, be it explicit or implicit change in behavior, that now when coming back into the algorithm means it will fail the various tests. So that also changes the mindset in terms of, do we audit it on a monthly basis, a yearly basis? I don't know, but that's something that has to be considered as well. So that actually goes to the question I want to go about the explainability by design. And it goes back to, I mentioned, well, what does that mean? Now, in principle, in theory, on a high level, fully on board, makes perfect sense. You want to make sure that whatever's designed across each level, we understand what's happening. But let's strip it down now to the technical level. What does that mean? What does the explainability by design literally mean? Does it mean I need to take now a nonlinear mathematical equation and explain to you in a linear fashion because we cannot understand more than 3 dimensions? Does it mean I need to explain to you fairness, as Yair was alluding to? Because notice a lot of explainability-based algorithms, actually, their explainability is by evidencing fairness. That is 2 very different things. So we really need to go down to what is it that we're really after. Now, personally, just to add, my kind of approach towards this and what I've been actually, having been doing it now in MES and not kind of more in the wild, is actually kind of taking a step back and say, you know what, look, as a human, you, for example, we build a friendship, I trust you. My trust isn't based on the fact that you will always and eternally make the right decision. In fact, you make some, I mean, obviously you won't, but you make some horrendous one. But I trust you that as from a kinship point of view, you have the ability to say, David, look, I mucked up. I made a mistake. I'm sorry. In a way, if you take that to the algorithmic world and the world of the accountability and explainability, I need to build up a setup that while obviously I want to have the algorithm as good as possible, my second, and in fact, line of defense should be the first. I need to be able to detect it. I need to be able to identify when things go wrong before the decision is executed. So for example, a credit risk scoring that comes out of an AI algorithm. Before I dish out that result, verify it. Is this something that adheres to what is my board, lines of explainability or acceptability. And if the answer is no, you stop it and then you go back to the algorithm, seeing whether there was a fault in the algorithmic approach or whether the fault was in data. Because remember, we had that data issue in the very beginning. But that then allows me to start operationalizing algorithms on a much more enterprise and, well, scalable manner, because I'm kind of saying they can go wrong, but I'm going to catch them. And I'm going to catch them before they enter the wild, effectively. So just a different perspective. I wanted to throw that in.
Thank you, David. Now, I'm just conscious of the time, and we haven't asked any questions from our attendees yet. So I just want to take this opportunity to open the floor to some of the questions. I know we have some on the chat, and you already answered one, but please, if you would like to speak up and ask a question.
Hello, Adam. Can you hear me?
We can, yes.
Hi. So this is Oliver from the Bank of England. So firstly, I'd like to thank Olivier, David, and you for a very interesting discussion. I have a question which I think relates to quite a few of the things we've sort of touched on here. So a lot of what we're really talking about, if we look at it from a firm's perspective, relates to model risk management. But I'm wondering, I'd be interested in getting all of your views. Do you think that, one, the traditional risk management approach, such as 3 lines of defense, is accurate and kind of effective model for AI-related risks? And secondly, do you think that there is the skills within the firms to actually ensure appropriate governance? So I'm not really thinking of the first line of control, but more in the second line, third line, and up to senior managers. Thanks.
Would anyone like to take that question? Olivier, perhaps?
So thanks, Oliver, for the question. The question of 3 lines of defense is actually a question we try to raise in the paper. That's true. It may be the case where, for example, the first line of defense will be substituted by an algorithm. So the question in the future, that's probably a little bit soon to have an answer, but the question in the future is if an algorithm, I would say, does the work of one of the line of defense, what type of monitoring of this algorithm will the bank have to develop to be sure that we still have the principle of, I would say, a number of controls which give enough comfort. The question of skills is a good one. That's probably one of our next steps. Of course, we're waiting for the result of the consultation. But I would be very interested in engaging discussion with internal audits of banks to see whether they start developing tools for audit. I believe that the third line of defense will still have to remain in a way or in another. And so that raises the question of skills. And maybe if I can reply to your question on the chat, we have not assessed all the different AI use case for the question of explanation, but we have listed a number of examples in the report, trying to analyze different use case and to have the corresponding level of explanation we think would be necessary.
Thank you, Olivia. David, yeah, would you like to add to that?
I want to go back to the part about explainability by design, and also I'll respond a second to what David had to say, and also later if I have time I will mention something else. Okay, so first of all, for explainability by design, okay, so let me ask you, so can we have explainability by design for everything? Sure, yeah, I mean, we can do that, right? For example, we can just make all bank decisions randomly. I mean, that's pretty easy to explain, right? How did you decide whether somebody gets a loan? Well, I flipped a coin and it came out heads, so that person got a loan. That's kind of the easiest way to explain a decision, right? Or everybody got it, right? So something like that. But the problem with that is that you're kind of trading off accuracy, right? So again, I really want, like, to always have that in mind, right? So whenever you're adding a constraint to a system, you say to somebody, like a regulator says, okay, the system has got to be fair, or the system has to be transparent, or something like that. You're adding a constraint, and that constraint will always come at the cost of something else. Okay, you can quantify it, you can try to balance them out, offer trade-offs, but you have to be always kind of very, very aware of that. The second part is, David mentioned that people sometimes confound fairness and explainability, and I completely agree, they're really not the same thing. So an algorithm can be perfectly unfair, but easily explainable. Again, like for example, I am not giving a loan to everybody from a certain protected minority, right? That's easy to explain, right? I mean, always give everybody except that group, right? And that's of course very unfair. And vice versa, right? You can have a very complicated decision-making process that just is applied equally to every single member, and that's and would be inherently fair, right? I mean, you can come up with something like that, right? So that's another important point. I think that. And I want to also answer quickly a question here. So there's a question about how can regulators in developing economies engage in this discussion and impact on AI given their limited resources. So I don't know much about the banking industry, but I do know that there are now specific research groups and think tanks that are focusing exactly on that with respect to bringing forward AI solutions in developing economies. So if you're interested, just drop me an email. I'll be happy to put you in touch with the relevant people.
Thank you. Thank you for also addressing that question. David?
No, I think just to build on what Olivier was saying, look, capabilities is absolutely critical. And again, let me make an analogy. We're talking about AI. We're looking forwards. Let me be on this one a bit of a Grinch and look backwards. Data governance. I would argue that one of the reasons why, largely, while everyone has policies for it, we've not been very successful in implementing it because there's still data governance issues, equality issues, which seep everywhere. And in fact, these would be amplified when it comes to AI, is because of lack of an understanding. It's a lack of understanding, lack of capabilities, lack of an appreciation. So especially, it doesn't matter how many lines of defense you have, which will still be there. It's a critical importance of having this appreciation. And in fact, if I had my way, just like when you join, financial institutions, you join a bank, and by regulation, by compliance, you need to pass these tests to make sure that you understand all that. I would put things such as explainability, such thing as governance, it is a compliance requirement. You need to go for these things, every single person within an organization, to absolutely make sure it permeates in the industry.
Thank you, David. Now, are there any further questions? There's some on there. There's one from Alexander Bukowski here. So for the panel more broadly, I suppose we can start with David and then go on to Yair and Olivier. But what are the areas of financial analysis that you feel will benefit most from automation through AI and machine learning solutions?
Well, okay, so man, where do you begin? So like I said, if you really, so automation, if you think about it, is really the lowest hanging fruit. And we have some very mundane, simplistic tasks from, financial reporting, revenue calculations, regulatory notices and returns that we have to submit, which are largely done by a lot of people kind of running around and putting numbers together. I mean, if you think about it, that is a phenomenal, if not a cost savings, in terms of at least driving consistency. And I always like to joke by saying, well, we can be wrong, but at least let us be consistently wrong. So that's a critical one when it comes to the automation in my personal view, and it'll just permeate outwards. Now, if you look one step beyond the eye, if I kind of tag it into this whole, I guess, regenesis of customers, which is really about me, it's really about understanding their needs. In other words, just give a very simple example. A person doesn't wake up one day and go like, well, you know what, I want a loan. Yeah, it's just always wanted one. And I wanted one with 5% interest. No, because they got married. It's because they bought a house. It's because they've had kids, many kids. there's a life moment, and data gives financial institutions who previously only look at it from a financial perspective that ability of, I can understand you a lot better in a not intimidating manner, to now be a lot more personalized. In fact, I'm pretty sure you'll hear this term personalization and hyper-personalization a lot more.
Thanks, David. Yeah, you?
So there's a question here, explainability techniques like SHAP can be very intensive from a computational and human capital perspective. Is this feasible for smaller and mid-term tier firms? At the same time, data scientists and engineers are not cheap to hire. Is this another blocker for smaller firms? What can they do to overcome and address these issues? Right, so let me start with the first part of it, right? So sharply value-based model explanations, which is something that we started out with back in 2016, and then later techniques like SHAP came about, kind of like repeated portions of our work. So they are computationally intensive, right? And this, there are companies nowadays, I mean, I'm involved in a couple of startups that do offer solutions. I'm guessing that for smaller or mid-tier firms, I mean, I'm not familiar with how it is, you know, specific pricing and stuff like that, but I do know that they exist, right? And they do offer solutions, and there are some open source solutions that are available, right? So you can, as I mentioned before, like some tech companies, again, like IBM, Microsoft, Google, offer their own explainability suites that you can, I mean, anybody can take them and use them if you want. But when I also want to repeat my other point when I said that, which is that if you want to, as a small company, to use a technique like that, I suggest that you exercise care, right? Because if you use those techniques and you don't really know like what the limitations of the technique, what it offers, what it doesn't offer, then you may end up with something that is completely unexpected. So one of the issues is with the techniques, sharply value-based techniques, for example, is that they're not very robust. So for example, if you use them in a slightly different environment than what you had anticipated, that it could cause significant issues, right? So there is robustness issues, there's also security issues that might come up. So what I'm trying to say is that for smaller firms, they do exist kind of like these free, kind of like open, let's say, solutions, but do exercise care and thought before using them. And perhaps it is worth your while and time and money to, at the very least, ask somebody to help you consult and to understand what's going on there.
Thank you. Yeah. No, we don't want the Bank of England to monopolize all the questions. So I want to get another point of view here. We have, I think, Nuno Pereira from the Banco de Portugal. Nuno, can you hear us and speak, or would you like me to ask the question?
Good morning to you all. I don't know if you are hearing me correctly.
Yes.
Okay, so first of all, thank you very much for this very insightful conversation and the sharing of ideas. I don't know exactly if there was a specific question, Adam, that you were highlighting. I can place this last one, which is, even though it's flipping a coin or something else, do you envision a future where financial institutions will be required to report to the supervisors which models they are using to take decisions? Either it's for approval loans, either it's for searching for fraud, AML, terrorism, and some other things. Thank you very much.
Thank you, Nuno. Olivier, I think you'd be best placed.
Thank you, Adam. Yeah, there are many things in this question. My first reaction would be, well, we have the experience of looking at models for prudential models, for banking prudential model. I'm not sure that it will be necessary in the future to have the same type of approach for AML, for example. But I can't say it definitely. It will depend on the criticity of the algorithm. I think if our approach is to see, we have to supervise processes, be it done by a human or algorithm, we have to supervise processes. So if you stick to this point of view, there will be no need to have approval of models if there is not a very, very strong reason for doing it. At the moment, I mean, I can see only the question of capital requirements models, but that's it. The other question probably underlying it is, will we have one day or another the possibility to have, I would say, a system of labeling models? I would say models which are considered as proper for anti-money laundering or proper for loan approval. I think that the question is emerging now. My personal feeling is that these depend so much on the use case. I mean, what we saw in the different companies, we asked for, use case on anti-money laundering, and actually we saw very, very different ways of implementing models. So if we still have this type of diversity, I think it will be very difficult to have standard models labeled by an authority or even the market or even consultancy. But that's, of course, I would say, my view at this point of the, at this point in time. But maybe it will evolve with the progress and maybe the standardization of the algorithm. But at the moment, I would be more on a very cautious position on this.
Thank you, Olivier. Yeah, David, can you also add some views? But then also, interesting question coming from Andrew Godwin, and maybe you want to, I'm not sure if you've had time to read that, but first, please respond to the question.
I'll try to keep it very short. It's more a case that, okay, on the one hand, I personally see no issue whatsoever in fact, I think it's beneficial in reporting what model is being used for what purpose. But I think as a sign of caution, we need to be absolutely careful of not resorting, into a world where we try and binning everything. Like, oh, no, for this you're going to use this model, this you're going to use, no. What to me is more critical isn't me telling you I'm using a stochastic neural network or whatnot for this underlying purpose, but as I mentioned to you, the entire process end-to-end of how it's being used, how I'm identifying the risk from that process, and how I'm managing that risk. Now, why that's critical is because you can find 10 different FIs using the exact same algorithmic methodology 10 different ways. And worse than that, I don't know if it's worse or best, is if you think about it, at the end of the day, all these algorithms are situated roughly, supervised, unsupervised, semi-supervised, et cetera, and so forth, on the same principles. So I can use any model that adheres to those underlying principles if it is able to meet the underlying objective that I'm pursuing. So then you'll be in a situation whereby you may have 10, 20, 30, 40 different models, which are all being used successfully in a single domain. How do you tell the difference between what's good and what's bad? So to me, in the end of the day is, when you ask an organization, are you able to estimate the underlying risk that you're exposing yourself from using this methodology? If the answer is, oh, we didn't think about that, that's a very clear indication. It's really looking at it from an end-to-end point of view. So I just want to bring that caution because from a different angle, I was asked by an aspiring data scientist, said, David, how do I keep up where every other week a new methodology comes out? From a supervisory, by the way, this is also why I say from a supervisory perspective, my personal opinion is you want to avoid, like the plague, the situation whereby you need to audit algorithms. The amount of labor you will need to hire is astounding.
Perhaps I will give a slightly different perspective on this, and this is.
Could we use that as a wrap up as well? That'd be very good.
Okay, sorry. Yeah, so I'll keep it very, very short. So also answering Olivier's, addressing Olivier's and David's comments. there are talks within the machine learning community now about creating something like the FDA, right? I mean, the problem of a large competitive market with high stakes is not new, right? We have it with, well, drugs, right? I mean, medicine comes out all the time. How do we know that we're not injecting somebody with something awful, right? There is a very kind of a very standardized process of testing the efficacy and the safety of medicines, and people are talking very seriously about applying it to like making sure that algorithms pass just certain standards and certifications, much like cars do, and much like medicine does, and much like a lot of other things, right? I mean, there's ISO standards for a bunch of stuff, from toys and whatever, right? So furniture. So why not algorithms, right? And that, I think, to me is a much more sensible approach, right? So just talking about what can you certify about your algorithm? What can you tell me about it for sure? And there is many reasons to believe that this is a good idea. One of them is, as David mentioned, auditing an algorithm is terrible. I mean, it's just not easy. Another thing is that it will kind of stifle creativity, right? If everybody has to follow a certain type of algorithm, then you will not have any opening to getting something new. But if you just tell me, look, my algorithm is guaranteed to maintain some notion of group fairness, or some notion of user privacy, or some notion of transparency, right? Or resilience to something else, to some other adversarial behavior. Then we can have a simple discussion, which is just a discussion about standards rather than a discussion about code, which I think is where we should be, because the discussion doesn't just involve like computer scientists who are comfortable-ish with reading and writing code, that it also involves, well, bankers, regulators, lawmakers, and so on. And these people need to be in the conversation as well. We cannot always be talking about technical stuff, because it's not just technical, it's normative and it's legal. So I think that's important.
Well, thank you. I know there are more questions coming through, and thank you to the panelists who are answering those directly as well on the chat function. But I think we have run over time, and I think this is probably a good opportunity to draw things to a close. I'm sure we can continue the conversation and have a similar engagement maybe a few months down the line, and with a fresh angle of the discussions. It would be good to hear more from some of the Asian central banks, some questions from them as well next time. So we'll see if that's possible too. But in the meantime, I just want to thank our speakers, Olivier in Paris, and David and Yae in Singapore. Thank you very much for joining us, and thank you all also for listening in, and wherever you are, please do look after yourself. Thank you very much.